It's Rick here for Friday, February 24th. Quick recap of the week and give you my thoughts for what I'm looking for, hoping for next week or the week beyond. So, starting as we always do with our model, it is ugly. Everything down below all the moving averages. If you're not already, it's time to be in cash and sit things out for a few days and see what's going to happen. Looking at the S&P, so the dailies here on the right, the weekly on the left. I'm going to start with the weekly. If you recall, if you've been watching some of my videos, when we made this move up here 3 weeks ago, I drew some lines on here on what I'd expected or hoped would happen. I didn't want it to keep on ripping because that would have been actually too dangerous. Going sideways for a while would have been fine, but my preference was exactly what's happened, is a retrace back to this ascending uptrend line. But unfortunately, we're just below. We closed this week below the 200 or the 40-week moving average, which is sort of a danger signal. But a lot's going to happen this next week, so not. So part of me says I expect a bounce, but I'm always prepared for the crash, or not, if not a crash, then keep on going down. So keeping the powder dry, but ready to load up on a moment's notice if things turn around here. I got the daily. Again, this just shows it's been a nasty week. We had a bit of hope yesterday. And then today just got dashed with the consumer price data this morning. The market just it's showed a little sign of promise by closing near its high for the day, but still significantly off the close from yesterday. So S&P looking really weak. Hughes paint a very similar story. Straight down. It's unusual here. The 50-day moving average is actually below the 200. So it's finding support here, but really this moving average should be above, in a good environment, this moving average is above the 200 days. So that's really not a good support area. So that's not looking too strong. Where we are seeing, and the Dow, same situation. The Dow, which was the strongest of the three, has now rolled over completely and is in danger of taking out these lows from last December. So that's not looking good. Where there is a bit of a bright spot is in the mid caps. I still had a nasty couple of weeks, but we're still above a rising 200-day moving average. And we got support today at the 50. So there's strength here and also in the small caps. Not quite as strong as the mid caps. The 200-day moving average seemed to provide some support here. The 50 and the 200 are very close together. So the place to be is in the small and mid cap companies. And that really shows up when you look at the so-called the NASDAQ 100. If you look at the top holdings of that, it's comprised of Apple. And just look at the chart of Apple. Not looking very pretty. Amazon, worse. Got up to the 200, then Crunch. Google. All these mega cap companies, that's a terrible chart. Facebook. Meta, I guess it's called now. Had a big gap up on earnings and then just can't hold it. Institutions just are seeing this as an opportunity to sell, and it's on its way down. Microsoft, and down more than it's about the same as the averages. NVIDIA is the one bright spot. If it weren't for NVIDIA holding up, it got a big gap up on earnings yesterday and held on to most of it today. So if this one had just performed normally, the Qs would be down even much more than they are now. And of course, Tesla is a dog. Yeah, bounced up to the 200 and then it's falling back off. So it's dead money for a while. So all of you that are still unfortunately in mutual funds, you own a SWAC of this kind of stuff. So yeah, not pretty. The big caps also, looking at the Dow, the 5 biggest companies that comprise the Dow, Goldman Sachs, not bad. Certainly not viable for my style of investing, but not too bad. Home Depot, whoops. McDonald's, still just dead money, just going sideways, doing nothing, has for weeks and weeks and weeks. Microsoft we already covered. United Healthcare, down below the 200. So yeah, these big cap companies, where most of the mutual funds are centered around, it's just dead money for a while. I can't see any light at the end of the tunnel. So, my preference is in these, the mid caps. The mid cap is defined as companies with a market cap of $2 billion to 10 billion. So, they're not Mickey Mouse companies, but they have some size to them, but they seem to be a good place to be. And in fact, when I look at my own holdings, and you compare the charts of the stuff that I'm in, I've got 6, 7 open positions. This is Celestica, trades on Toronto and New York, right up near the highs. This is a $1.6 billion company. So, definitely a mid cap. This one is specialty chemical company, CSW. I have no idea. I never really heard of them. But they're a $2 billion company. So again, this chart looks a lot better than some of those big cap ones. MOD is a auto OEM manufacturing. I've been in this one for a while, traded it very well. Exited here, got back in here, and I still have a original position from down here. So this one's looking pretty decent. This one is a $3.8 billion bank in Brazil. Not a very pretty chart, actually. This 200-day moving average has been coming down and just now starting to flatten. So this makes this one dangerous. So I'm playing it very tight stop. I'm not going to give it any room, but good workout. Saputo Cheese, another Canadian company. I don't know what their market cap is because I don't get any Canadian data. But again, the chart pattern looks great from my perspective, the way I trade. So I think when I outlined this one a few days ago, I said, I outlined where it came up to the all-time high here, pulled back. This pullback was shallower, came up to the all-time high again, another shallow pullback. And then I expected some resistance as we get still here at the highs because there's going to be some supply. And in fact, that's what's happened the last couple of days. But it's absorbing that really nicely. So again, if this one just tightens up, stays within this range here for maybe the most of this week, at least 2 or 3 or 4 days, and then rips out from there, I'll be adding to this position. That's just an ideal setup. TGLS is a building in the construction business, 1.7 billion market cap. Just starting to set up now. I entered a little early here, and I opened poorly this morning, but then recovered. So we're just right back to our break-even point right now. So my stops are where they're indicated. So if I got stopped out, I got stopped out. And then the last one's the biggest company I've got by market cap. It's Toro, the lawn care company, building hand tools, I guess they're in. That's a $12 billion market cap. And again, it's not performing to my liking, but it hasn't really done anything wrong yet. Unless it just goes down from here, if it can turn back up. I'll be looking to add to this one over this level here at $115, I will add to this position. So that's it. What I'm looking for, let's go back to SPY. Go to the weekly chart again. What I'd like to see over the next 3 weeks, it might take that long, might take even longer, but is if we can hold here, go inside this week, come up here, 3 weeks, and then the 4th week, come up here, and then we get a test. So that would be an ideal situation. I'll be long somewhere in here, looking to get very protective as we get around here. And then depending what happens, either we go sideways from here, or we just keep on ripping. That would be a great scenario. Obviously, what we don't want to have happen is a whoosh down from here, because we could get down underneath here. Yeah, a lot of bad things can happen. Since the last 3 weeks, we have come down. We've lost from the peak, and we're closed today. It's over 5%. So that's enough to should have been enough to get all of you out of the market. I mean, you go back to the year to date where we started the year here. We started at this point here, and we're now only up 2.1% for the year. So everything that was gained up here has been lost, but it still is slightly positive for the year. Personally, I'm up 4.1%, so a little bit more than about double what the indexes are doing, which, considering this market, I'm not displeased with. So I think that's about it. I think what I fear longer term is, let's just remove these things here. But I fear that this moving average, the 200-day moving average, or the 40-week moving average, has now gone sideways. And what I fear is it goes sideways for the whole year. I think there will be a period of time, and I've talked about before, where the Republican Party in the US refuses to allow legislation to raise the debt limit, and then we're going to see a crash. But I think it will be relatively short-lived, but it will cause a lot of terror and angst if you still have any exposure to the market. But even if that does happen, I think by the end of the year it's going to recover. So, but my worry is that we do something like this just for the rest of the year, and we go nowhere, and it's just dead money. You get invested when you get above the 200 or the 40-week moving average, then you got to sell it when it gets below, and you buy it again when it gets above, and you just get chopped to pieces, and you don't make any money when all is said and done. So that's just a terrible environment to be in. I was going through some old charts, and this is exactly what happened in 2015, 2016, and it's just very, very difficult if you're an index investor. So if you're just buying the S&P or the Toronto Stock Exchange or one of the big indexes, or mutual funds, God forbid, that's what's going to happen. So you might want to think about looking at sectors as a starter. If you're not interested in looking at individual stocks because you think that takes too much time or work, that's fine. So maybe look at some sectors, because when the market does this, the money stays the same. They just change the flavor of the day. So could be oil and gas, could be solar stocks, it could be mining stocks, it could be, anyway, money's flowing from one to another. And so you can make money in this kind of an environment. You're trading a bit more, maybe a couple of times a month. But and it takes a little bit more work to review all of the sectors. So if any of you are interested in a list of the sectors that look promising, I'll be glad to do that this weekend. I do it every now and then. I don't trade the sectors very much for myself, but for those of you that may be interested in this approach, I'll be glad to give you my 2 bits worth and which ones to consider and which ones to clearly avoid. Okay, that's it for now, unless I come up with anything really interesting on the weekend. So cheers, everyone, and everybody that's here in Vancouver. Stay warm. It's going to be cold, and apparently there's a bunch of snow coming. So I'm just going to button up and look at some charts over the weekend and sit by the fire. Cheers.